What if I told you that the reason your balance keeps dropping actually has absolutely nothing to do with market makers, unpredictable news events, or even just bad luck? What if your trading account doesn't die because of the market at all? What if instead it dies because of you? Just imagine a trader, maybe someone a lot like you, who watched their account grow 30% in a single morning. They felt entirely on top of the world. But by nightfall, that entire account was completely gone, zeroed out. And the truly terrifying part? They didn't even realize it was happening until it was way too late. So, welcome to this explainer. Today, we are diving deep into a pretty brutal reality of the financial markets, and we're looking at exactly how emotions destroy trading accounts. Let's get right into it. Part 1. The invisible trading enemy, a psychological war. Look, if you've ever watched a 30% gain just vanish into thin air before dinner, you already know the battlefield we're talking about. Every single day, thousands of people jump into the market dreaming of financial freedom. But here's the thing. Most trading accounts do not blow up because of bad technical analysis or because a trend line was drawn a millimeter off. Honestly, you can have the absolute best strategy in the world. Perfect indicators, flawless entries, the ultimate holy grail setup. But if you pair all of that with uncontrolled emotional decisions, none of it matters. That flawless strategy is instantly neutralized by just a single emotionally hijacked reaction. Moving on to part 2, the 5 emotional killers. Let's do a little autopsy on the usual suspects here. The very first silent killer is fear. You see a little flash of green on your screen, you panic, and you close the trade way too early. Sound familiar? We've all been there. You do it because you're terrified of losing what you've just gained. So instead of letting your winning trades actually grow and hit their logical targets, you just snatch small profits over and over again. And fear tricks you. It doesn't feel dangerous. Actually, scratch that. It feels incredibly safe. But snatching tiny profits just leads to account stagnation. Mathematically speaking, it's the fastest path to failure because your small wins are never ever going to cover your normal, inevitable losses. Right on the heels of fear comes greed. You string together a few nice winning trades and something internal just shifts. You start increasing your lot sizes, you over-leverage. Suddenly you think you're the next Warren Buffett and you've completely cracked the code. But the market absolutely does not reward that kind of arrogance. It punishes overconfidence severely. Greed is just that little voice in your head whispering, come on, just one more trade, or just a little bit more leverage. And it literally only takes one bad trade under those conditions to expose your entire account to total ruin. Next up, we enter what is probably the most destructive phase of all: revenge trading. A loss hits, and instead of just accepting it as a normal business expense, you take it personally. You feel insulted. So what do? You fight back. You start using bigger lot sizes and faster entries with absolutely zero analysis. At this point, you aren't even trading anymore. You are irrationally trying to hurt the market. But guys, the market is a cold, emotionless probability machine. It feels nothing. And revenge trading always ends exactly the same way, with another devastating loss. Then there's anxiety, which usually creeps in right during a drawdown. When those losses start stacking up, anxiety just grabs the wheel. Suddenly, every single candle on the chart looks like danger. Every tick of the price feels like a personal attack against you. You completely stop trusting your proven system. You exit early, you hesitate, you freeze up like a deer in headlights. The crazy thing is, at this stage, your underlying mathematical strategy is probably perfectly fine. It's your mindset that has completely broken down. Finally, we have the most deceptive killer of the bunch: overconfidence. A winning streak creates this incredibly dangerous illusion of invincibility. You start to believe you literally cannot lose. And this is the exact moment your discipline just vanishes. Stop losses removed or widened. Risk management completely ignored. Practically overnight, a careful, methodical trader transforms into a reckless gambler, and the market aggressively punishes anyone who stops respecting its risks. Let's look at a real-world example in part 3. Autopsy of a blown account. The case of Daniel. So Daniel is a totally normal retail trader. He starts out with a modest $2,000 account. Now look at how fast this all unravels. Week 1, Daniel pulls in a solid $300 profit. Week 2, an incredible $500. He's feeling absolutely unstoppable, right? He's staying up late, watching trading videos, basically convinced he's a Wall Street wizard. But then comes the shift. Just one single losing trade. A tiny, insignificant $120 loss. It shouldn't have mattered at all. But he hesitated. He doubled his next trade size just to recover it immediately. And it worked. But that early success completely doomed him. The next week started with another loss, but this time he didn't wait. He entered again immediately. Bigger trades, faster entries, no plan. He just spiraled. Within just 48 hours of that initial trigger, Daniel watched his account hit absolute zero. That was the exact moment Daniel lost his account. It wasn't the final trade. No, it was that moment he doubled down just to recover a tiny $120 loss. He completely abandoned his logical discipline for pure reaction. He was no longer trading the market, he was blindly reacting to his own pain. He couldn't stop, because stopping meant accepting failure. So he just kept pushing until the machine took every last dime. Which brings us to part 4, the market's real game, exploiting human behavior. Here's the truth. The market isn't some malicious entity out to get you specifically. It is just an incredibly efficient machine designed to exploit perfectly predictable human patterns. That is exactly why 90% of traders lose money and only 10% actually survive. Those emotions we just talked about, the fear, the greed, the impatience, the revenge, the market doesn't look at those as mistakes. It views them as recurring data patterns, and it recognizes them instantly. People lose money not because they don't know a strategy, but simply because they lack the ability to control themselves when real money is on the line. So we have to completely flip the way we think about this. In the grand scheme of trading, your strategy is entirely secondary. Yes, of course you need one, but it is not the main driver of your success. Psychology is everything. Risk management is the absolute bare minimum requirement for survival. If you don't have the psychology to execute your strategy without emotion, the strategy itself is completely worthless. Consider this your wake-up call. The market does not destroy traders. Emotions do. Every single emotional trade is a direct step toward your account hitting zero. And you know what the absolute most dangerous moment is? It's not when you're losing money. The most dangerous moment is when you are acting emotionally while falsely believing you are still in control. That illusion of control is what makes the destruction completely invisible right up until the money is gone. So let's fix it. Part 5, the survival framework, controlling yourself. How do you actually survive this environment? Well, you don't survive by predicting the market perfectly. You survive by controlling yourself perfectly. Here are your non-negotiable rules. Step 1, trading plan discipline. Every single trade must be predefined. Entry, exit, stop loss, risk. If it's not planned, it is not a trade, period. Step 2, risk management rules. Never risk more than a tiny, predefined percentage per trade. Survival always comes before profit. Step 3 is the emotional control technique. Before you click buy or sell, you have to ask yourself, am I reacting right now or am I executing? If emotion is driving the click, you step away. And step 4, trade journaling. You've got to log not just the numbers, but your emotional state during the trade. This is exactly how you spot your own toxic patterns before the market exploits them. I want to leave you with a direct challenge based on everything we've unpacked today. Look at your recent history, look at your losses, ask yourself honestly, are you actually trading the market or are you just trading your emotions? Because if you cannot control your own impulses, there is no indicator, no algorithm, and no strategy in the world that is going to save your account. The hardest enemy you are ever going to face on the charts is the version of you that refuses to stay disciplined under pressure. Every blown account starts with just one emotional decision. If you want to survive in the market, you must first survive yourself. So the next time you sit down at your terminal and you feel your pulse start to race, who is really in control of the mouse? Thanks for joining me on this explainer. I'll see you next time.